All right, let's begin again, please. Mr. Bailey.
All right, thank you, sir. I'd like you to move to slide 25. I want to talk a little bit about expected returns. So we talked about the idea of compensated risk and this notion that stocks ought to return more than bonds because they hurt us in periods when we don't want them to. Expected returns is the sort of the translation of this notion of that stocks are riskier, and how do we go about calculating the future returns on those instruments? Well, as I point out here, high-quality bonds, it's a fairly straightforward way. We can look at current yields. If we see the current Treasury is yielding 30-year Treasury is 2.8%, pretty much if I invest in Treasuries today and hold it for 30 years, I'm going to get 2.8%. There isn't a whole lot of argument about that. Stocks, it's less clear. Any risky investment, it's less clear. And I just point out that there's really two primary methods that people go about using to calculate expected returns. One is historical returns, and probably used more often than it ought to be. Is we look back and we say, well, how did stocks do over some particular long time period? And we say, well, maybe that's a barometer of how they're going to do in the future. Certainly we know stocks have outperformed bonds, and so we're comfortable making the statement we think in the future that that's a likely possibility, but by how much? And historical returns are a questionable way to look at that excess. Fundamentals is probably a more appropriate way to do it in the sense that you might have some sort of long-term PE ratio. There's a thing called cyclically adjusted PE, a Shiller PE. That's a pretty interesting way to go at this. But essentially, price over earnings is one way to think about it. So if I know what the earnings are today and I have some ratio that I'm comfortable with, price over earnings might be 10 times or something like that. If I can make a forecast of the E today, I could make a forecast of what my price is going to be in the future based on those earnings today. The problem is that PE tends to fluctuate over time, and that's difficult to use in a forecast, but it's an interesting way to go at it. Another way that's commonly used is what I call risk-free plus historical equity risk premium. That's essentially the idea that stocks ought to perform, as we talked about, ought to perform some excess over other instruments like bonds or treasury bills. And so the idea is that I may have some premium that I think that stocks historically deliver, and if I know what my risk-free rate is today, maybe long-term treasuries, something like that, I would add that premium on top of that, and that might be my forecast for future returns. That means that as the risk-free investment, the treasuries go up and down, the yields, then my expected return for the future goes up and down as well. The other way to think about that is to try to really break down the building blocks and say, well, I'm going to break down my stock returns into an income piece and a growth piece, an inflation piece, and I'm sure your staff has probably done this sort of analysis before, and I won't go into details about how we might try to put that together. But again, the idea is that there's some market-based building blocks that we would use to forecast future returns, and I think that's probably a commonly accepted way to approach that problem. And so you do get fluctuations over time. In some periods of time, stocks could be reasonably expected over the long term to do better or worse than they've done historically. We're at a period of time when stocks have performed extremely well. If you looked at the PE side, we'd look at PE ratios as being very high right now. And so the Shiller PE would forecast that expected returns on stocks would be relatively low over the next 10 years. And that's a conundrum for investors that are trying to build portfolios that rely a lot on stocks. But it's a fundamental way to try to approach the problem, and I think it's a sound one. Alternative assets are a little bit more difficult to engage then in once you've made some sort of estimate of what you think your publicly traded equities are going to do. How do you attach a premium then to private equity? More often than not, it's some sort of additional amount, 1 or 2% on top of that. Presumably there's some payment for an illiquidity that you go through in owning private equity. Maybe there's some element of active management that you attach to owning private equity. But usually there isn't a market-based rationale for having that premium. It's just some sort of expectation that you're You're essentially anticipating this additional amount will be earned, but it's not driven by anything other than perhaps some historical observations. So it's a difficult situation to develop expected returns for private equity, to rationalize them in the same way that you can rationalize public equity returns.
Ms. Brown?
Thank you. And you may have already answered my questions, but we have been hearing from staff and our consultants that expected returns will be declining, and that's because equities are overvalued, and we're looking at the ratio. Instead of being 10 times, they're like at 15 or 17. Is that what we're looking at, or can you help us? Because it looks like the stock market's doing well, so we should be doing well.
Well, I will. You don't pay me enough to be a market prognosticator.
I'll pay you.
In fact, the zero that I get paid is about what you should expect in terms of the value of my giving you market prognostications. So I'm going to defer on that question. You have much wiser advisors than me that could give you the answer on the future.
Yeah, it just would be helpful to have that explained more broadly in terms of for this board and for our stakeholders, because we keep talking about that the investments or the returns are going to be lower. Right. But if anybody who you don't even have to watch Bloomberg or CNBC, you can just watch the regular news and hear that, not today, but that stocks are going up. So it just seems counterintuitive to lay people about the returns are going to be lower.
I guess my response would be simply that you should look to some of these fundamental measures that I've pointed out there. So if the analogy would be with bonds. So right now you're basically, it isn't quite calculated this way, but if I took the current yield on bonds, and so long treasuries are yielding 2.8%. In the 1990s, they were yielding 7%. Okay, I had a lot of confidence in the 1990s that I would earn at least 7% by owning a long treasury if I held it to maturity. Today, I'm pretty confident I'm going to earn 2.8%. How come? Well, the P has gone up, essentially, or the E has gone down, whichever way you want to look at it. But in the bond world, the price earnings is a lot higher in bonds than it was in the 1990s. So you think of that as being lower expected return on bonds. That's no one has a problem thinking about it that way. But then you move on to stocks, and the same sort of phenomena is going on, where the price has been bid up significantly relative to the earnings. In the bond world, we're happy to say, I think I'm going to earn less. Well, in the stock world, yes, there are a number of other things that impact the E that I may not know about, and I might be hopeful that there will be positive influences on the E, but you can't deny that the P over the E is a lot higher now than it was in 2009.
Thank you.
Go ahead.
All right. Let me talk a little bit about risk. I want to not get too deep into this issue because we could go down a rabbit hole that will never come out. But I think there are some important elements of risk that I want to just lay out in this session on basic risk and return issues. There are lots of lots of categories of risk, and I like to think of risk in this very broad sense, that it's really the idea that you're going to experience losses in pursuit of the fund's mission. And I've read some of your mission statement material, and it's very well written, and I can see all sorts of ways that you might have problems accomplishing that mission, not because you've done something wrong, but because risk is present in your program. And so investment risk, but there's funding risk, operational risk. Ann has pointed out all sorts of other risk issues to me that you might encounter. I completely understand those, and in the sense of how they could impact your decision making. Our focus is going to be on investment risk, but I realize that you have a very difficult job in dealing with those other forms of risk. Like I said, we're going to talk about investment risk in this session. The other thing that I'd love you to pay a little bit of attention to, and again, this goes back to this notion of blinders, I think, that people running one organization suffer from, where you just see your mission, and you forget that other organizations have different missions. And I like to say that all investors really face the same capital markets. I mean, for the most part, we're all choosing from the same list of assets. But we have different missions that influence risk for us. So when you think about the risk for a endowment fund, for instance, an endowment fund has to pay out a stream make a stream of payments to beneficiaries inside that fund. And there's a lot of organizations that whose mission is to make sure that they don't have big fluctuations in those payments to their beneficiaries. A university or something along those lines wouldn't want to cut those payments. That's a completely different mission than a pension fund in a corporate plan that's frozen, and there are no new members coming in. There, the mission of that organization is largely to just protect the funding surplus that might exist. Well, you folks face a completely different sort of situation, a public fund that is open, new members are coming in. You trying to protect the interests of the taxpayers. If you can earn a high level of return, you reduce the amount of contributions. On the other hand, if markets perform poorly and additional contributions have to be put in, it can hurt the beneficiaries, it can hurt the taxpayers. So there's a lot of different elements of those missions that I think are important to recognize. And I think it influences what risk is to each of those various organizations. And that's simply the aside that I want to make sure that everybody understands, that it isn't, risk is not necessarily a one-dimensional item. There's a lot of different elements to risk that, and different organizations face it in different environments. Quantifying risk is one of the big difficulties. A lot of organizations don't even try. I mean, they just accept some sort of basic rules of thumb, and they'll set some sort of policy asset mix, and they don't revisit the issue. I personally think that's a mistake, but it's not uncommon, unfortunately. Practitioners, I think, that are aware want to look at some sort of measure of the volatility of their outcomes relative to the mission. And that can be done through a number of different ways. Despite all of the problems, and we'll talk about them just a little bit, with measures, a measure known as standard deviation, it's probably the most common risk measure out there. And it's a measure of how much a particular metric fluctuates around a mean. And like I said, I'll talk about that in just a moment. There are more complex risk measures, various measures of downside, just looking at one part of the distribution of possible outcomes. Value at risk, stress tests, they're all interesting. And I'll bet your staff probably spend some time looking at each one of those. But in terms of conversation and making a presentation to a group of trustees and how you folks ought to think about this, I'm a believer in using standard deviation of returns as a measure of risk. This is your standard bell curve, and for those of the uninitiated in the statistics world here, I won't dwell on it for a long time, but if we think of the mean here as just being 0, one standard deviation around the mean captures 68% of the outcomes. 3 standard deviations captures over 99%. And so we use standard deviation as a measure of volatility around that mean, whatever the mean is. In your case, let's say you chose the mean to be 7%, your expected rate of return on your portfolio. You might ask, what's the volatility of our investment program around that 7%? That would be one question that conceivably could come up. But when you're looking at a manager's performance, you might say, how volatile is that manager's performance relative to the benchmark? You'd use standard deviation potentially as a measure of that. There are problems with standard deviation. They assume exactly what I'm drawing up there, that normal distribution, that bell-shaped curve. There's a lot of argument that investment returns aren't normally distributed, and that makes it difficult to use standard deviation as a measure of risk. I'm sympathetic to those sort of arguments, but in the end, I really believe that in terms of the conversations that you guys are likely to have, I think focusing on the standard deviation of returns, whatever the particular investment process that you're looking at, whether it's a manager or your asset class returns, is probably the most straightforward way to try to address the problem. Let me hop to this slide here very quickly. This is on page 31. This is just a stylized view. Again, I'm looking at 0 as sort of the center of this distribution, but we can shift it over if we wanted to. But basically, if I thought of the blue as being bonds and I thought of the red as being stocks, we'd say that bonds are less volatile than stocks. That's what we say when there's a higher standard deviation. So that distribution is less dispersed. The blue distribution is less dispersed than the red distribution. And probably just as importantly from your perspective, looking at the left side, what I'm going to call the tail of the distribution, the left tail, that's where all the bad things happen. And a bond portfolio has less of its distribution sitting in the negative territory than the stock distribution does. I mean, that's the notion of stocks that's how we would quantify that difference in risk. So when your team might say that you have a standard deviation of higher on the stock side and then on the bond side, they're pointing out that the left tail has more downside than the bond side.
If I may, I would like to provide a little bit context of our fund. So in the most recent AIM, our assumed rate of return over the mean here, Jeff showed you the distribution mean centered at 0. So our target rate of return, the mean is 7%. And then the volatility is about 12%. But what does that mean? 7% mean and 12% volatility. So if you plus or minus 1 standard deviation, if minus 1 standard deviation, 7 minus 12, so negative 5%. If you plus 1 standard deviation, so 7% plus 12%, that's 19%. So it means that the range of the outcome, there will be about 68% of the time, the outcome of our portfolio will fall between negative 5% to positive 19%. So that's, we put in context of what this means, plus or minus 1 standard deviation means. So there will be 68% of the probability, if our modeling were right, there will be a 68% probability that our portfolio return will fall between negative 5% and positive 19%.
And of course, just to add to that, everything Ben said is obviously accurate, but just to add to that, that means that 32% of the time you would expect it to fall outside of that. So losing more, down more than 5% or potentially up more than 19%. Just the converse there.
Mr. Jones?
Yeah, thank you. Yeah, Ben, on that comment, this is not symmetric. If we were to lose 5% on the tail side, 5% doesn't get us back to where we were.
Correct. It is symmetric. The example I just gave you is symmetrical around 7%, not around 0%. But I was trying to say that the range of outcome is wide. 68% is between 1 plus minus 1 standard deviation, but which means also that there is 32% of the time will be either on the left or the right of that range. And of course, we are more worried or concerned about on the left.
Yeah, right. Yeah, but my point, though, is that if 7% is the center and we lose 3% of that 7%, we gain 3% back, we're not back to 7.
Oh, correct. Yes, you're talking about once you take a big loss, your base is lower.
Exactly.
Your base is lower. Say if you start with $100, you lost 20%, means you get to $80. But if you gain 20% from $80, it gets back to $96. It does not get back to $100. So that's what you're talking about. Exactly. That's why drawdown protection is so important. If you just look at the return, it seems like you lost 20%, you gained 20%, you should be back up at par.
Right.
But that's not the case.
Exactly.
And that's why it's so important to protect the downside.
Exactly. Okay.
I'm going to hop ahead a couple of slides to slide 35, if you don't mind. And I want to talk a little bit about risk capacity and risk tolerance. And then I'm going to talk a little bit about protection against tail risk. And actually, Ms. Taylor, I'm going to get to some of your comments at that time as well. So, risk capacity. I think this is really important for any investor, and it's true for a large investor. It's true for an individual investor. Is what is your financial ability to endure losses? That's different than what you're willing to incur. And I think so often organizations confuse the two. I think Ben was talking about some liquidity issues. In a down market, you may run into serious liquidity issues. You have big payouts that go to beneficiaries on a monthly basis. The capacity to survive large negative returns, large drawdowns, has to take into account a lot of different elements, but one could be liquidity. And if you're not taking into account that risk capacity, you might find that find yourself in a situation where your ability to meet your financial goals has been damaged. Now, like I said, that's different than your willingness to bear investment risk, and you can get two different tendencies here. Some organizations have a lot of risk capacity and their trustees are not interested in bearing a lot of risk. Other organizations may have less risk capacity and their trustees are willing to bear a lot of risk. The two have to sync up in some way, and presumably the conversations with the staff and other experts help you to do that. But I think it's important to bear in mind the difference between the two. Risk capacity is probably a little easier to calculate than risk tolerance. Risk tolerance is a subjective issue. Individuals and groups have different limits on how much volatility they can stomach. The big problem I've always found with organizations that have a lot of turnover is they lose all the institutional knowledge of how bad it was. If you go back to 2009 and you find people that went through 2009, they don't ever want to do it again. It was a very scary time. I honestly believe that the United States financial system was just one or two serious bad news items away from a much more catastrophic collapse than occurred. It didn't happen. That's great. But if you were there at the time, you remembered how scary it was. And that helps you judge, to a certain extent, how much volatility you're willing to handle. Those individuals that haven't been through that sort of environment, they're a little bit more willing to say, look, I see stocks beat bonds. I mean, I can handle that, no problem, until the next serious downturn occurs. So, and then bringing together a group to produce that group risk tolerance measure is extremely difficult. Again, if you have, to the extent that you have individuals in the group with different experiences. So I don't have great advice for you how to do it, but I think it's one of your most difficult and important jobs is to arrive at a group risk tolerance decision. And if I was going to say to any organization how much time they ought to devote to discussions of returns and discussions of risk, I would point to risk, and I would point to trying to understand our risk tolerance much more than I would try to understand some of the return opportunities. So it's a challenge.
Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, Ms. Bailey, you make reference to groups. So who are the relevant stakeholders in this risk tolerance discussion?
Well, I think that's a great question. I think looking at some of your documents, you've identified stakeholders broadly, and I think that makes a lot of sense. I mean, taxpayers are clearly a big stakeholder in a organization like this. The beneficiaries are huge stakeholders in an organization like this, and I think that makes it why your job is so difficult. You not only have your individual risk tolerance ideas in mind when you come into a meeting like this, but you're trying to funnel the attitudes of those other stakeholders into the decision making. And I don't have a magic formula for it. That's why your job is tough. But certainly those stakeholders that I just mentioned are clear, important elements in that decision.
Yeah. So trying to honor that involvement. We have 13 members on this board to discuss risk, and we can't have another 25 going back and forth at a board meeting. So we do have our asset management liability workshops, and that would offer the stakeholders the opportunity to come and testify on their beliefs of our risk tolerance during that time.
Right.
That makes sense?
Absolutely.
Okay.
Ms. Middleton.
Okay. Thank you, Mr. Bailey. This has been, for the new kid on the block, really helpful.
Thank you.
But could you give me some ideas as to what benchmarks, what kind of standards should we be using when we're engaging in a discussion as to what our risk tolerance should be?
Well, I think a lot of it has to, this is just my personal opinion. I think you'll find a lot of other individuals who may take a slightly different approach. I happen to be a big fan of stress tests and looking at not only what happened in the past, but with the right simulation models to be able to say what could happen in the future. And then you get into the question of how much volatility could I actually stand? First of all, you go back to that question of risk capacity, and your staff can help answer, what are our limits on the ability to bear downside? But then also, how can I place myself in that sort of position and say, I've seen this happen, or I can see how it might happen. How would I answer the questions if I saw that my portfolio was down 25% in 1 year? Those are issues that are best done with experience. I don't have any doubt about it. But at least having some sort of, to try to pre-experience the future by having those simulations, I think is very helpful.
All right, thank you.
And I'm sorry, I'll just add quickly, twice a year we come with a series of those sort of stress tests. So we do a stress level review twice a year in February and August, and you'll see those then.
Mr. Railing?
We touched on the idea of tail risk. I showed you those two distributions, and I want to just talk a little bit about the idea of managing tail risk. Again, tail risk is really the left-hand side of those distributions. And what is that three standard deviation event that might occur that is going to cause me or my organization so much heartburn? We've had two long and sharp stock market drawdowns really in the last 15 years. I suppose it's more like 19 years. But going back to 2001 and then going to 2009, those were very serious declines in the equity market. And so tail risk really is something that people pay a lot of attention to. How do we try to handle that? Well, I list four possible strategies. I say diversification. We'll talk about that in a moment. Insurance strategies. I mean, you can buy protection against market declines. It's extremely expensive. Few organizations do it on a long-term basis, but it's certainly possible. I'm also going to talk about risk parity in just a little bit, not promoting it, but just as a way to try to tackle tail risk. And then there's these idea of black swan strategies. There's a very interesting author, Nassim Taleb, who wrote some good material on this. But basically, these are taking very deep out of the money sort of investments and having this protection that only pays off in catastrophic events. You don't see very many organizations taking that sort of approach. But those would be four ways to try to protect against tail risk. I do want to talk about diversification here for a moment on page 38, or slide 38. The cheapest and the simplest option is diversification. The idea is building out a portfolio whose returns the assets don't move together at the same time. We refer to those as low correlation assets. And I truly believe it's the one free lunch in investments. After the fact, as we'll talk about in a moment, you always would rather have had something else. But basically, in going forward, it's the one way that you can try to protect against risks that essentially just tries to take advantage of compensated returns. My message to trustees is that they should be ensuring that all the diversification opportunities have been considered. Now, that doesn't mean that you shouldn't be aware of some problems, that there are assets that in a highly stressful environment become highly correlated. And we saw that in 2009. All the world's equity markets declined at once. You didn't save yourself by being diversified in international stocks versus domestic stocks. And there are plenty of investments that I would refer to as gratuitous diversification. It really doesn't provide a lot of diversification. It just looks like you have diversification in your portfolio. But, Ms. Taylor, the point that I want to get to is right there on this slide. This is slide 40. So I'm looking for assets that, even in stressful environments, don't have high levels of correlation. That is, they don't tend to move together. And this is why bonds end up in portfolios. High-quality bonds end up in portfolios, because they don't move together. even in the most stressful environments, they don't move in lockstep. Stocks and bonds don't move in locksteps. Now, you have to be a little careful. I'm talking about high-quality bonds, long-term government bonds, agency bonds, and so forth. If you start to slide down the quality spectrum, then it becomes less clear that there's a negative correlation or a zero correlation between the two.
If I may, on this note, a very important note of diversification. So Mr. Billy just showed you, in terms of diversification, we are looking for the asset class that lowly correlated or ideally negatively correlated during time of crisis. So he talked about how stable the correlation is. You want it to be low correlation when you need it. The other aspect to it is that very unique to the market environment we are in today. So the biggest source of risk in our portfolio is the growth risk or equity risk. And historically speaking, the best diversification to that risk is really the high-quality government bond and the corporate bonds. But how did that happen? So normally in the past, when the financial crisis comes, usually the Federal Reserve will cut interest rate, and that will boost the diversification benefit from the government bonds, high-quality bonds. But also in the past, if you look at recent past, on average, the Fed had to cut 300 to 350 bips. But now we are still in the low interest rate environment. The 10-year note, like called 240 roughly. We won't have another 350 bips to cut in the next downturn. So we have to be mindful that when the next downturn comes, the diversification benefit from the high quality government bonds may not be as strong as it has been in the past.
The risk of getting into too much statistics, I'm going to pop back to page 39 and just make sure that the trustees who aren't statistically minded understand this idea of correlation. So basically, when you measure the way two returns move together with this idea of correlation, and you can go from -1 to +1. +1 means that they move in lockstep in the same direction. And so if you look at the left-hand side, you can see the return on stock A and stock B. You can see how they line up there, a straight line going upwards. So the idea is that those two return series tend to be almost perfectly positively correlated. So as I say, examples might be stock market returns and economic growth. Those tend to be very highly positively correlated. Compound yield and total wealth. The higher my yield, the greater my wealth grows. So those are variables that move together in the same direction. So I would talk about those as having a correlation of +1. I'd love to have just the opposite. I'd love to have assets that move in a negative way. So in other words, when one is going up, the other is going down. And that's what you see on the right-hand side, stock A and stock C. They're negatively correlated. You can think of bond yields and bond prices as being negatively correlated. If bond yields go up, bond prices go down. Gas prices go up, and world oil production goes down. We're going to see a negative correlation. Excuse me, gas prices will go down if world production goes up. So the idea is that we'd love to have returns on assets that move have a negative correlation, a -1. They're hard to find. And a lot of times we have to settle for 0. And that's what you see in slide 40. Bonds, long-term government bonds and stocks historically have about a 0 correlation with each other. There are periods of time when they can move in the same direction, but more often than not, they're highly uncorrelated. And sometimes they're even negatively correlated, which is why they provide protection and why so many investment organizations put bonds in their portfolio. Not because of the high expected returns on bonds, but because they provide that protection in bad periods of time.
Ms. Taylor, any other?
Yeah, so I appreciate you bringing that back around so that you answered my question. But I guess when I look at that diversification, we also can only invest so much in bonds because we want to reach a certain rate of return. So that in and of itself sort of counteracts the hopefulness that that diversification will mitigate some of those losses. So what's the solution to that?
Well, if I can put words in your mouth and trying to reach that 7% expected return, you have to take more equity risk in that portfolio, is the
Right,
feeling,
right.
And so you invest in assets that don't have that zero
Correlation.
That's
Right.
right. That's right.
So we're just stuck.
That's the dilemma that so many public funds have gotten into. I mean, but endowment funds are the same way. They're trying to earn high real inflation-adjusted returns, and they take a lot of equity risk in their portfolio. And you're more susceptible to 2009s in that situation.
And historically, I mean, these were not high rates. We've all lowered our rates compared to where we used to be.
Exactly. But if you look at it compared, we talked about this idea of using the risk-free rate as a base. Again, 10-year treasuries are at 2.4% right now. So you have to, your equity risk premium has to be really high to get you to 7% total portfolio return.
Right.
And that's difficult.
Thank you.
Mr. Rubalcaba.
Thank you. My question is similar to Ms. Taylor's. Talking about the diversification, and I noticed you skipped the slide, or maybe you didn't, about the 100-year flood.
Yes.
I mean that's a concern, I guess, I have. I was like, well, what? I mean, how much protection can you get in those situations? I mean, the
Yes.
3 deviations, whatever you call it, 3 standard deviations scenario.
I think the 100-year flood slide ways back. I go over it here. Page 30, yeah, there. Yeah, that's right. Oh, my beautiful picture of the flood was taken out.
Sorry.
Oh, that's all right.
That's the accessibility translation.
No, the point of this was simply that a lot of times we misspecify the probability distribution that we're concerned with, and that's a risk for any investor. You're only interested in what the world looks like going forward, and so you're trying to estimate the probability distribution of returns for different types of assets. Now, your staff is doing that, and if you stick with the old history, sometimes it can be that the history is moving, the expectations are moving and you haven't caught up with it. And so the point of this slide was just simply be careful about looking at history and using that to make your judgments for the future. Today, the probability distribution for some cities that live near rivers, they can look at the probability distribution from the past, and the odds of them being flooded out in a 100-year flood was 1 out of 100, basically. And now all of a sudden they experience a lot more floods. Well, the answer is the probability distribution has changed. Global climate has changed the distribution of flooding in their area, and so they should be paying attention to that. That was the point I was trying to drive at in that particular slide.
Yeah, if I may, I detect a little bit concerning tone from some of you, which it should be. When we talk about the diversification of the lack of the tools we have in today's market environment in diversification, what should we do? So we all, relatively so, we all should be concerned. But if I may, can we go back to slide 19 very quickly?
19?
19, yes. So if you look at the drawdowns, so this is the sustained period of drawdown. So in financial history, there has not been a recession that has not been fully recovered yet, at least. So what my point is that it's about the staying power. As long as you can stay through the downturn, the market eventually recovers. There are individual companies that did not recover, but as an index, that's the, again, benefit of diversification. If you invest in an index or the broader market, eventually will recover. So as long as we can sustain the downturn, how do we ensure that we can sustain the downturn? We talk about the importance of liquidity management. What would force us to liquidate or get out of the position at the worst time? Either we need money or we panic. So what do we need? We need money. We need money. We need to pay members' benefits and some other liquidity need of the total fund. As long as we can monitor and manage our liquidity profile very proactively, we can mitigate this risk. And also, we need to remind all of us, when the time comes, keep calm and carry on. Do not panic. Do not panic in the downturn. As long as we have the ability to sustain it, eventually the market will recover. And what will be even better in that situation, if we have dry powder we can deploy in the down market to take advantage of the recovery of the market, that would be even better. So that's the secondary goal. First, make sure we can survive the downturn, and then let's take advantage of the downturn. And if we can do that, we can mitigate these risks. We can never avoid or eliminate the risk completely, but we can mitigate it. So just to give you some comfort that this is a topic we are constantly, every day or every minute or every hour of it, the whole team thinking about this conundrum or the challenge we face now.
Anything else, Mr. Wakaba?
Nothing.
Mr. Miller?
Yeah, just as you were speaking, Ben, thinking about this diversification, it does strike me that when we look at across the entire portfolio, we try to diversify, but also within those asset classes. And looking at the way the equity markets in particular have been changing and evolving, going back to that whole climate change thing, it's not the same world it was 10 years ago in terms of what's happening and our understanding of it, these burgeoning changes. And so it seems that, part of that discussion needs to be as more of the opportunities that we seek that would help us to diversify are not available in a public equity setting, aside from the extent to which they may be represented in some fund. It seems like private equity has to be a big part of our diversification strategy, and not just diversification, but also, the flip side, trying to avoid undue concentrations. And so is that something you're seeing kind of across the industry, Mr. Bailey? Is everyone grappling with the same kind of challenge?
They are. Let me just highlight just a couple of additional slides here that might help to drive at that question. And we're getting close to the end, so I'm gonna jump around just a little bit here. Let me get to the point about diversification smooths real returns. This is slide 43. So this is a 50-50 stock bond diversification. So in the red. And you can see that in 2009, a 50-50 portfolio was very effective. You still had a negative draw. I mean, you still had a drawdown, clear, but you recovered much quicker, and you had nowhere near the depth of that decline. In the 1970s, the stock-bond correlation was actually much higher, and the reason being that bonds were being hit by inflation at that time. And so that goes back to this issue of the distribution of returns and how correlated assets are. So these things are changing over time. It's not a static sort of environment. And working with your staff and consultants and so forth, I mean, it's the job of the trustees is to feel comfortable that they have some sort of vision of the future about how you think the world is going to operate. Of course, this is all expectations. There's no guarantee that any of that is going to work, but you can't just sit and look at the history and say this is how things are going to happen. And my point on that, again, is on slide 45, you can see these changing correlations between stocks and bonds. And interesting, you also see the changing correlation between U.S. stocks and non-U.S. stocks, where the correlation has gotten greater over time as the world has become more global and more integrated. So again, trying to build those expectations into your portfolio, I think, is one of the greatest challenges that you face, which leads me to one final segue then on that idea is, Mr. Miller, is on page 46, or slide 46. What I did was, what you have is you have U.S. equities. Those are valued on a daily basis, and then we have private equity and real estate that are not valued on a daily basis. These are oftentimes appraisal prices or some other estimate of the value of those securities that occur at best on a quarterly basis, sometimes even less. And in trying to build risk models to incorporate alternatives into the portfolio, you have to rely on some of that stale pricing information that goes into the analysis. And it's a challenge for staff and consultants to try to bring that information into play. You can see the historical volatility over this period, 1993 to 2018. I picked that because I had some data on the private equity and real estate world over that period of time. You can see that stocks had a volatility, a standard deviation of 15% a year. That's pretty normal, pretty reasonable. This reports private equity to be 9.8% and real estate to be 4.2%. I put down believable. I say no. I mean, it's not believable. It's not the fault of anyone that's building these benchmarks here, but because of the pricing that goes on inside these models is at best stale. You don't have an apples to apples sort of comparison when you try to build those into risk models. And it's Ben's team's challenge to try to build some sort of way to integrate private equity and real estate into the publicly traded assets. And that's not easy. I don't envy them. But I think as trustees, you should have your eyes wide open when you see those sort of numbers laid out. How volatile do we think private equity is? How volatile do we think real estate is? What will it do in a 2009 sort of scenario? How do they correlate? Is it a good diversifier or not? It may be a great asset from an expected return standpoint, but what are its risk characteristics? How do we incorporate those into our modeling? So, again, it's hard. You aren't the only organization that's facing that. But as you get larger allocations to alternatives, it requires you to make those sort of decisions. That's my point. It's not fair to say, I don't know, and as a result, I just won't pay any attention to it. If it becomes a meaningful portion of your portfolio, you have to pay attention to it.
Go ahead, Mr. Bailey.
All right, I'm going to finish up. I am going to skip past a couple of slides here, if you don't mind, and just finish up with a discussion of active and passive management. And just want to be clear on this issue, what we mean by active and passive management. Active management, as I say here, is a strategy that's designed to outperform a particular benchmark. And you do that by holding positions in your portfolio that are different than those of the benchmark. Passive management just means you're trying to track the performance of that benchmark. And we talk about active risk as being how volatile is your performance relative to the benchmark. And the idea of active management is I take active risk with the idea that I'm going to earn an active return. I'll beat the benchmark by some amount. And we alluded to this earlier. Unlike market risk, you don't get paid for taking active risk. You may be smart, you may hire the best managers, but you don't get paid for it. On average, the active managers are going to underperform the passive management approaches. I mean, that's just the math. Bill Sharp did a great article back in, I think it was 1992, where he wrote the arithmetic of active management. And he just basically laid out a very elegant argument that said, active managers in aggregate after fees have to underperform passive managers in aggregate. Now, if you're smart, you hire the better active managers and you can outperform the passive side of things. But you can't expect to outperform passive management just by holding active managers.
Sorry, I couldn't hold back. I had to add something here. So I totally agree with, and I am familiar with the study by Dr. Sharp, the Sharp ratio, the Bill Sharp. So in aggregate, active management has to underperform passive management because of the fee and other friction cost. But on this, I would like to challenge a question for Jeff as well. Then why so? There are so many people out there still trying active pursuit of these active risk management. Is that in the hope or in the illusion of overconfidence that you are better than the average? You can beat the market. So what is it? The fact is simple math is out there, but the activity around it is still prevalent, and people talk about it, still trying to do it.
Right. I wouldn't say that it's a bet that I'd want to make. When I work with pension funds, we passively manage the vast majority of our portfolio, but I understand what you're saying. There is a prevalence of active management. I could attribute that to habits, to kind of hoping that we'll all do better than average. I live in Lake Wobegon country, so we know that all of our children can be above average, and we can succeed. But I think it is what Sharp laid out is a challenge to any large pension fund or endowment fund, is how can we take active management and actually turn it into something productive for ourselves. The fact that there's a prevalence of active management can be chalked up to great marketing on the part of active managers. Like I said, can be chalked up to hope or delusion on the part of funds. I can't say exactly why it's remained that way, but it certainly is true. There's more active management out there than passive management, but the math is pretty straightforward on that issue.
Ms. Middleton.
Okay. Thank you, Mr. Bailey. Could we go back to slide 48?
Sure.
And I'm just intrigued by the concept of risk budgeting and the framework.
Yes.
Should we be using the same type of framework for publicly traded assets as opposed to private assets?
Ideally, yes. I go back to that slide that I had pointed out before, where the inputs have to work. I mean, the famous idea, garbage in, garbage out, is certainly true when it comes to risk budgeting, where you're dealing with usually a fairly intricate model of how assets correlate with each other and your expected returns and the volatilities. And if your inputs are poor, you're going to get a poor result. So I think the challenge for so many organizations is how do you develop the best inputs? And so that's where I go back to saying, well, I think my expected return on private equity is equal to public equities plus something, and my risk is equal to public equities or something like that. Just that isn't the way to approach it. I think you have to. I think the challenge is much more complex than that.
Anything else, Ms. Middleton? Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, could you go back to slide 26? It's something you said that triggered something I remembered back then, and it's
Sure.
And I know that at the bottom you say our focus will be on various forms of investment risk, but then right above that you do list some other categories, one of which is reputational, and also, which I don't see anywhere, is geopolitical risk. We just in a tariff war with China and U.S. right now, and some believe it may be short-termism. It may go away in June, but then it's possible it's a long-term, and the impact of that is not only affecting U.S. and China, but it's the global economy because we invest all over the world. So do you have any thoughts about geopolitical and reputational risk to guide us for that discussion?
Well, when you say thoughts, they're worthwhile being concerned with. The question is, in terms of your investment analysis, how do you incorporate them into those probability distributions that you're working with? So when we think about geopolitical risk, I mean, it certainly is an element that my U.S. Treasury bonds are going to pay off whether there's geopolitical risk or not. That doesn't affect the probability distribution of U.S. Treasury bond returns, but my domestic equity investments, it's certainly the case that a trade war with China could impact the value of my domestic equity holdings. So somehow I have to build some sort of probability distribution that perhaps takes into account the fact that returns are more volatile because we have an administration now that is more willing to fight globalization and change the potential outcome for domestic companies because of trade wars. I mean, I don't have a modeling answer for you, but I think it's appropriate to say how are we going to incorporate some of those issues into our expectations.
Okay, thank you.
Mr. Perez.
Thank you. Shocker, I'm confused. To answer Mr. Rubalcava's question earlier, why can't, if we should just be more passive or active, then his response to the people asking him would be, we're doing it wrong?
I will never say you're doing it wrong or doing it right. That's not fair. That would be incorrect of me to do that. You have to make that decision. You actually gave me a great segue to close the active-passive discussion, if you don't mind.
Absolutely.
Okay.
Thank you.
I mean, I view it in this world here, active management belief statements. And I think there are really five beliefs that you have to be able to say yes to before you would engage in active management. One is the existence. First, you have to believe that successful active managers exist. Second, you have to think that you can identify them. And that's easier said than done. I mean, and this is going forward. You can look at performance in the past and say they were successful, but your judgments are all going forward. Third, you have to structure them. By that I mean you have to be able to hire them, to put them together in a portfolio that you're comfortable with, the risk level of that portfolio. Fourth, you have to be able to tolerate the potential volatility. That could be reputational issues, or it just could be losses that you suffer because the managers underperform their benchmarks, but you have to be able to tolerate that. And lastly, you should be able to say that I actually need the extra risk that's associated with that portfolio of active managers. Now, your answer may change depending on the particular asset class that you're looking at. I don't mean to say that you're going to get the same answer by answering it once. You have to evaluate that in different levels. But my argument, and maybe my response to Ben, is I think the world is a little bit backwards on this, where passive management ought to be the default option. I mean, you should start with a passive. This is Jeff Bailey speaking. You should start with a default position that passive management is our approach, and only to the extent that we feel like we can answer yes to those 5 belief statements in a particular set of investments would I be willing to engage in active management. So when you say, am I right, are we right in doing what we do? Well, I say, can you answer yes to those statements in particular asset classes?
So if I may, this is a very important topic. So if you think about active management relative to passive management means that you can buy the benchmark, just buy and hold the benchmark, passive, don't do anything active. So the active means that if you think you can beat the benchmark, you can outperform the benchmark, either by owning more or less than the benchmark on a particular security, say Apple stock. And for you to do that, say you think Apple stock is going to outperform the passive management, so you overweight Apple stock, means that on the other side, someone has to be willing to underweight the Apple stock. And the Apple stock either go up and down, cannot do both ways, right? So either you are right or the other party is right. So it means that for you to consistently to beat the benchmark or beat the passive investment management style, you have to be able consistent to be right or better than the average, than the market. So that's the challenge. And then Jeff just mentioned that when we say the active management, we are mostly referring to in public asset classes, where the market is rather efficient, the competition is very strong, and that's where we need, back to Jeff's comment, where do we want to be in active? We want to be in active where we have a structural comparative advantages. And in public market, it's difficult because it's so efficient and competition is so strong. But relatively speaking, in private markets, such as private equity, we do have some structural comparative advantages, and perhaps we can be more active in private asset classes. So basically, you pick your battle, right? You pick your battle, which battle you want to pick on, and based on your conviction in which market you think on average you can beat the market or beat the benchmark. So that's maybe a way to answer your question. Our view on active risk management, we had to pick which asset class we want to be in, and certain asset class probably will better served to be more passive, and certain asset class will be better served to be more active.
Go ahead, Mr. Bailey.
Well, I think that actually at this point, I promised I would wind up by a quarter after, and I almost did it. So I think that concludes my remarks. I'm happy to answer additional questions.
Very good. I see no other questions from the board, but I do have one from the audience. L.R. Roberts, please come down. Please state your name and affiliation for the record, and you'll have up to 3 minutes for your comments. The microphone will be turned on for you. This one on your closest to you.
So today, I'm being National Lawyers Guild, even though I am a member of two retiree groups. I'm on the National Lawyers Guild board locally. But we have many other National Lawyers Guild members who are PERS members. I totally disagree with the idea that classes of investments should not be banned, and totally disagree that trustees should not be involved in picking particular classes or even particular investments. And the CIO should report directly to the board. An example of the kind of class of and the kind of investments that we shouldn't do is private prisons, especially now that these sleazy organizations are being used to jail small children. I have had clients be held in private prisons, a federal one here in California, for instance, and I would not let a dog be held under such conditions. PERS is our money. I do not want to invest in cruelty and exploitation.
Thank you. Seeing no other requests to speak, thank you much, Mr. Bailey, Mr. Meng, everybody for your presentation. Seeing no other requests, I think we have exhausted this event. Great educational opportunity. Thank you very much for your time. Ms. Simpson, thank you very much. We have agenda item 9 left on the agenda. That's public comment. I do have two folks from the public who would like to speak, Jeff Perry and Ann Glatt. Please come forward. Use the two seats on your right, my left. Speak your name and your affiliation, please, and you'll have up to 3 minutes for your comments.
Good morning, Mr. Fechner and the committee. My name is Ann Glatt, and I am a driver for Lyft for the last 4 years, a full-time driver in the Bay Area. I appreciate the opportunity to address this board regarding the risk that the business models of companies like Lyft and Uber present. Our organizations, Gig Workers Rising and Mobile Workers Alliance, have sent you a letter that fully details these issues. To briefly summarize, the classification of Lyft and Uber drivers like myself and independent contractors does not, in our view, serve your interests as public agencies. Treating us as independent contractors lowers tax revenue that funds your system. Also, because the companies do not pay enough and provide no benefits, drivers are often forced to rely on publicly funded social services, further hurting government budgets. At the same time, these companies depend heavily on public budgets for roads and bridges in order to function. These companies bring more risk to you in the investment markets. For example, both Lyft and Uber acknowledge in their own documents the issue of classification of their drivers and driver dissatisfaction in their makes their business model risky. There are many other risks for you to consider, including legal and regulatory issues, and the fact that neither of these companies has shown a plan that will make them profitable. On May 8th, many Lyft and Uber drivers did not sign on to the app to drive in order to bring attention to these issues. For this reason, I'm here today to ask you to review the information we have shared in our letter and to have your staff engage the leadership of both companies to encourage them to work towards a sustainable business model that serves everyone's interests. Thank you.
Thank you.
Good morning, Mr. Fechner and members of the committee. My name is Jeff Perry. I'm a driver for both Uber and Lyft. I live in Sacramento, but I commute to the Bay Area for work primarily. Like my colleague Ann, I appreciate the opportunity to address you guys today. I stand in solidarity with all my fellow drivers who did not sign on for work last week to raise awareness of the issues we face as drivers. Some of you may have seen the CBS National News piece I was part of that aired last Wednesday. And I'm going to briefly share with you why my experience as a driver shows me that the current business model of these model of these companies is not sustainable. These companies rely on us working unreasonably long hours under conditions. These apps are designed to keep people driving and deter drivers from taking appropriate breaks. It makes the roads a more dangerous place. It's a devastating culture for driver health and safety. And with the, as Ann mentioned, the reliance on a lot of the public services, that taxes those Medi-Cal and other benefits. This is also a platform that relies on the defiance of law and leaves investors on the hook to absorb the financial liability when the law finally catches up with them. The culture at both Uber and Lyft is intentional and not accidental to defy the law, as became apparent as multiple emails they've sent me over the more than 3 years I've worked for them, instructing how to avoid law enforcement, and if the event that you get a ticket for, say, an illegal pickup at the airport, how they will pay for that ticket. These are things that affect public safety and public works as well as the tax base. In closing, I hope that you can see why we need to work together to make changes in how these companies operate. Thank you.
Thank you. Thank you both for being here today and for sharing your information with the committee. Thank you. We have one more request to speak, Emily Goldman. Just come forward and speak your name, and you'll have up to 3 minutes for your comments.
Good afternoon. My name is Emily Claire Goldman, as many of you know. I'm the founder and director of Educators for Migrant Justice, and I am here on behalf of hundreds of CalPERS members who are outraged that their pension fund is still investing in companies that are aiding and abetting the migrant abuse crisis. To my knowledge, there has been only one update provided to the board since this engagement began. So I would respectfully like to request that the board make a request for another update. If that update, to the extent possible, could be provided publicly or at least to your stakeholders, that would be very much appreciated, though I do understand that there is a very limited amount that can be provided in that regard. But without this follow-up, we have no idea what's going on with the engagement process. How many times have they met with the companies? Are they meeting with the executives? Who are they meeting with? Have they visited the facilities? There's a lot that we can't know if this dialogue and internal communication is not happening. I would also, and I understand this is not a back and forth questioning time, but I would be curious to know how CalPERS voted its shares at the GEO shareholder meeting last week, specifically on the issue of how they implement their human rights policy, since the board was initially not on board with that. They eventually reversed course, but only days later, they were again restricting access to legal counsel at one of the family detention facilities in Texas. And there is an upcoming CoreCivic shareholder meeting in a couple days where I would like to know how CalPERS is planning on voting its shares. We want to talk engagement. This would be an important opportunity. There is a proposal before CoreCivic to have executive compensation tied to their human rights impacts. And again, they have challenged it. So. And while challenging it, it's still moving forward. So that would be another important place for engagement, and one that would be important for your stakeholders to see. I would also still point out, since I didn't have the opportunity to address you at the last couple meetings, that specifically when we talk about the fiduciary duty and the training that you all have had, that it's an objective standard, not subjective, and yet we do have a relatively wide consensus among responsible investors that at least the two for-profit prison companies, CoreCivic and GEO Group, are not prudent investments. And more importantly, one of the factors that's supposed to be considered is whether or not the investments negatively impact your beneficiary's ability, their employment opportunities.
You've run out of time. Thank you, Ms. Goldman.
Thank you so much.
Thank you for your comments. Seeing no other requests to speak, the open part of the agenda is adjourned. We will be going to closed session at 1:15.